Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan Lomax, and it is a pleasure to be with you today as we learn about the economics of mom and pop. Jonathan O'Kane is Vice President and Head of Research at Chandan Economics. At Chandan, he blends data with storytelling, bringing forward unique coverage of all things related to mom and pop rental housing. So, Jonathan, take us into the show by sharing a memorable experience from your formative years that helped you to be who you are today.
Absolutely. And first, thank you for having me on the show, Alan. Appreciate this. Regarding a formative experience, I think I'd have to go back to my days at Pace University. And instead of a social life, I decided to join the Fed team. It was a competitive monetary policy team, which it's kind of similar to Model UN, which some people in their collegiate or high school experience may have gone through, but this was kind of more on the economic side. And it really helped me to understand the value of hard work. I think before that point in time, school very much came easy, but kind of put into this experience and having to really understand things, not just at an inch deep level, but really being able to connect the intricacies of the economy from one unrelated topic to another. It was a really unique experience. Definitely checked your ego a little bit. I went to Pace University, as I just mentioned, which is not one that you typically think of when you think of the Ivies or kind of in that same breath. But within this small little program, we were beating the Harvards, we were beating the Yales. We had won the national competition a couple times, while I was part of this large team. And I believe that they had won, this year as well. Shameless little plug back to the alma mater. But just being able to kind of put pieces together on a macro level and being able to kind of have those kind of conversations. I thought that going through that for a couple of years, even if it was kicking my butt in the process, it definitely helped me to kind of exit there and be able to have those conversations thereafter.
Well, interesting. Sounds like a great program. What attracted you to that?
Going in to undergrad, it wasn't the fact that it was an extracurricular that kind of ended up consuming the life. I went in as a business undecided, quickly fell in love with economics, realized, hey, this is the study of everything that I am actually interested in. I just didn't know what to call it. I was reading for economics in 10th and 11th grade back in high school. And then walking into my first Econ 101 class saying, oh my God, I'm one of the actually people that not only enjoys this, but I can't wait for the next class. It was really kind of a natural progression into the monetary policy side. It was almost something that once you fell into the major, and if you were kind of performing at the top of your classes, you were kind of recruited into. So it's in many ways, everyone within the econ department has a hand in it in some respect or another. We kind of always viewed it as we were a little bit of a family and we all have a little bit of a hand to play.
You were probably a pretty small family. I think you're probably 1 in 1,000 who goes, I really enjoy economics. Most people hear the term and they run.
I'm quite used to that for sure.
It's a fascinating topic, but it can be daunting, certainly for, I think, young people in particular.
Sure.
But tell us, just give us a definition of what you're talking about when you talk about mom and pop rental markets. Well,
I think, mom and pop rental markets is really kind of hitting those, the smaller landlords, the ones that have, say anywhere from 1 to 50 units under management, that is really kind of, perhaps they're not professionally managers where they are, one of these national landlords, but it's something that is their retirement for their kids. It is something that is, supplementing their otherwise income, or they're doing it professionally, but they, don't have the same scale as some of those bigger players. So, the types of access to capital, the access to information, the access to, tools in the management, we definitely see a divergent set of trends across the board, between those two groups.
Well, you say that the mom and pop markets have been really much more sensitive to the pandemic than the professional markets. So what do you mean by that?
So our company has recently partnered with RentReady. I believe you had their CEO on the show as well as Ryan Barone. And their property management software is entirely for those small mom and pop independent landlords. So we have been able to use their data and put together a rent tracking tool that is similar to what the National Multifamily Housing Council is putting together on the professionally managed side. So once we started to actually dig into that data, we were able to make interesting comparisons based on that independent side versus that professionally managed side. What we were noticing is that, sure, we were seeing a little bit of a dip on the professionally managed side. So that was using data from RealPage and Yardi and the NMHC data, on the scale of 2 to 3 percentage points from pre-pandemic to the dog days of the pandemic. Versus in ours, we were noticing a quite large drop off, sometimes seeing on-time payment rates as low as 70% on some months in the summer of 2020. So it really kind of spoke to that, hey, I think we all really knew it going in, that there was, the scale of the distress that these mom and pop independent landlords were feeling during 2020 and even into 2021 was really out of concert with a lot of the national data that was being reported. We were seeing some of it in the Census Bureau data that was a little bit more kind of anecdotal, but this kind of helped us to put a data point to what we were really hearing in conversations from the market.
Yeah, and I don't know of too many organizations who really separate that out and look at that mom and pop class of rentals there. So there really is a lack of information there. But you were saying that even though they took a bigger dip, they are recovering pretty much by this time this year. But it has really taken this long for them to make that recovery, whereas the larger and more commercial operations, a lot of them, overall, there really wasn't much of a dip in terms of collections and rental markets.
You're right. And our most recent data point for March 2022, our preliminary data, it was the first time that we reached above that pre-pandemic trend. So as we're looking at it, it was something that was reaffirming for us that we were very excited to see it, just as we want to see the health and recovery of the sector in itself. So to see that was a big milestone.
We'll be right back after a brief announcement. Are you a busy professional, passionate about the work of your calling, yet realize that even though you love what you are doing, you're exchanging your time for money? You know that if you were to lose the ability to exchange time for money, your financial well-being will be in jeopardy. If you can relate, I have great news. Steve Tucker Capital is an investment company designed for professionals to develop financial independence built on solid passive real estate investments. Remove the anxiety of an uncertain financial future and go to stevetucker.com. Get your free one-page 10-step guide to passive real estate investing.
Yeah, it is quite a big milestone. Have you been able to analyze the data and really, come to conclusion as to the cause that the mom and pops took a bigger dip than the more commercial properties?
It really comes down to the credit quality of the tenants themselves. Who is renting in the professionally managed side? Much more of that renter by choice rather than the renter by necessity. Within those, you have probably renters that were less likely to lose their job as a result, ones that were more able to transition into work from home setups versus this kind of also piggybacks off of some of the small multifamily research that we do partnered with Arbor Realty Trust. But within these small multifamily rentals, that there is definitely a pretty large difference in the types of tenants that are there. And I believe in our rent ready sample, the majority of units, or rather the modal component, the most is coming from those that are renting below $1,000. And the distress is really concentrated there as well.
Is that difference in the tenant makeup, is that a management issue, or is it the facilities issues, or the quality of the facilities that different between commercial and mom and pop?
I would argue is probably more of a facilities issue.
Okay. So it isn't just the size that we're looking at in terms of mom and pop. They're older facilities, I'm guessing, and
you tend to see that. It tends to be something that's a little bit further away from a core central business district, something at a lower price point. And there's definitely a degree of collinearity there where a unit costs less and therefore is going to attract a lower income renter as a result. I think that what tools like Rent Ready have allowed for is the same way that you see a collinearity on the tenant side. Perhaps there was a collinearity on the operations side where, because of higher price points for professional kind of softwares, including priority matrix and the likes of it, it may have not made sense for that smaller landlord to kind of graduate from using spreadsheets. So using that software, it's really allowed them to kind of become more professional in their operations. And we've seen this both within our lending data, but also kind of confirmed with data reported by the National Apartment Association, which is over the last 7-8 years, as we've really kind of seen this increase in tech adoption from smaller landlords, that their operating expense ratios have come down precipitously. So it's allowing these mom and pops to really have a more profitable operation just as a factor of running more efficiently.
Have you been able to do comparisons between those who are using the rent ready and comparable landlords that are not?
Unfortunately, no, we haven't. It's kind of difficult in the sense of we have a one-stop shop. If we have access to the data, then they're part of the sample.
Yeah, I would think data collection would be a problem as well, and getting equal data from those who don't have that access to that quality of management.
We'll throw it on our research list, on our little wish list.
Yeah, it would be difficult to do that. So renters, they talk about a lot. I'm wondering if it's as big a deal as it has been, but there's a lot of talk about demographics have shifted because so many people can live where they want to live now because they're not returning to the offices, they're working remotely.
Sure.
Are you seeing that? And is that making a difference in the mom and pop rental markets?
To a degree, as a result of the pandemic and, its impact on work from home acceleration, really you're kind of seeing two broad trends. The first being what was referred to as the donut effect. I can't remember the economist that coined it, but it's effectively in central business districts. Now instead of having to come in 5 days a week, maybe you have to come in, 2-3 days a week, and how many hours a week that you have to commit to commuting, maybe then you're willing to live a little bit further away from the office, get a little bit more space at the same price point because, hey, I'm willing to accept a 45-minute hour commute 3 days a week, and that's equivalent to me 30 minutes, 5 days a week. So in that sense, we've seen an acceleration towards suburbanization, and at the same time as the need to go into a physical office place is diminished completely, especially on the more white collar side of the corporate spectrum. That has more profound implications for divorcing residential space from office space. If I'm able to take my New York income with me to go live down in South Carolina, that is very impactful both to markets here and markets there. And, not so much an issue necessarily from the mom and pop, or rather not unique to mom and pop landlords, but I'd say this more of a regional gentrification story where a lot of the national conversation has been on, that renter deciding to move from the high cost California, New York City, Boston to the Sun Belt, and achieving a higher degree of affordability. And this has kind of, in a lot of ways, been framed as a positive affordability story. But, we're skeptical to say that. We understand that, they're coming in and achieving a higher degree of affordability, but cognizant of the fact that, they may have not been the one that at their New York, Boston incomes at earning $70,000 might be a little bit stretched in somewhere like New York, but they weren't necessarily in themselves in a crisis, versus now they're moving into somewhere like a secondary market in the Sun Belt where local rents had been calibrated to local incomes. And now if I am a landlord in these markets, I could be saying, hey, I have 10% of the market is new demand this year, and they all have higher incomes than my existing renter population. I'm going to set my rents based on those incoming incomes rather than the previous incomes that have supported these rentals. So we've noticed this in a lot of the rent growth figures where we're seeing the highest level of rent growth within those Sunbelt markets where we have positive migration flows. And then within our rent tracking data, the data is mixed. So we don't want to be raising too many red flags because frankly, the data is not strong enough to support it. But we definitely do see to some degree that those Sunbelt metros that are seeing heavy migration inflows, a certain deterioration in their ability to accept rents on time relative to non-Sunbelt metros. But the reason that we kind of hypothesize there is that same argument. If I'm a landlord in one of these markets, I'm saying I can boost my rent by 17% and I can get a renter in. So I'm incented to do so. And then if my renter is unable to keep up, then I'm likely to see some deterioration there from my existing renter. So it's something that we very much have our eye on.
Yeah. Well, there is a trend from what I understand that institutions are going into the single family market, single family rental market. And most of that, from what I understand, is generally new construction for the purpose of renting. So 2 questions here. What is the impact on mom and pop with institutions entering that market? And the other question is the same thing happening in a small multifamily from 10 to 50 multifamily?
So let's answer the first question first. The impact of these larger players moving in, I definitely think there's a degree of debate. Hey, like on the one side, is it the case that these larger institutions are eating more of the pie? But then we're definitely of the mind that they're also creating a bigger pie. It was the case that the Census Bureau puts together the rental housing finance survey every 3 years. And if you look at what these large institutions, what their share of ownership for multifamily had been around 8% of total units. So even though we think of this as a much more institutionalized asset class, still like they're a minority, even if they're getting a majority of column inches and press. We noticed the same thing happening within SFR. In 2018, they're about 2.5% of ownership. We're waiting. It's going to be, I believe, the spring or the fall of next year that we actually get the 2021 results. But we would expect that to start to rise closer to the multifamily share, but it's still going to be a number of years of catching up. When it comes to the impact on those smaller landlords, you can make a case that you have more games in town, that's more competition. But at the same time, over the last number of years, that increased institutionalization has actually been a new strategy for these smaller landlords to play, where it had been just you rent, you collect the income, and that's the end of it, versus now you can almost view yourself as a feeder for larger institutions, trading up to the next larger portfolio. So, if you're a small landlord that knows your market well, that delivers quality product and able to operate your units efficiently, there's still a value to being in that market. And I would just argue that you probably have more options available to you now than less.
That's encouraging. Well, what about institutions moving into a small multifamily where you scarcely find institutions involved in that market?
Right. I think it's a lot of the same argument. I think that, the agency has kind of moved into that market a number of years ago and really created a new set of liquidity there. You see, increased institutional participation, somewhat on the equity side, but even more so on the debt side. A lot of the research that we've done has been with Arbor Realty Trust, who is a mortgage REIT that was one of the first to really target that small multifamily part of the market. And it's increased appetite across the board, especially with the affordability crisis that we have right now. Based on our tracking and based on, frankly, most tracking, anywhere from 75 to 80% of the affordable housing supply is naturally occurring. So we call it naturally occurring affordable housing, NOAA. And these small multifamily units, or even getting down to those 2 to 4 family units, those really make up the bulk of what's available to a workforce renter or a low-income renter.
Well, Jonathan, you just have a wealth of very, very valuable data. So how can our viewers and listeners take advantage of that and get in touch with you?
Sure. So to get in touch with me, it would be okane@chandan.com. That is OKANE @chandan.com. As far as using the data itself, our body of research is available at chandan.com. We've recently released that independent landlord rental performance report with RentReady. It launched back in December 2020, and we're updating it on a monthly basis. So we cut our data the 15th of the month and look to release it that week after. So we have just released the March 22 report, and around April 20th or so, somewhere in that ballpark, we begin to release the April report that talks through preliminary data as well as the finalized March data. With that, it really kind of gives a different and unique perspective on smaller landlords and the health of the housing sector. It's an area that we don't have as much data for, but it makes up the majority of the market. So we're hoping that the usability of this data is really kind of used as a health and gauge for both users and policy makers alike. And, as far as our future ambition with the data, we're looking to start to increase new and interesting statistics to go along with the rent tracking. We're in development of an occupancy series that talks through the same, mom and pop landlords, rent growth. We're making sure that we're weighting it appropriately to national trends. So we have our data scientist, Dylan Zito, working on that. And eventually we're looking to be able to branch into making this a true data service, where if you go in and say, hey, I am an owner, I kind of fit these qualifications or these specifications, I want to know more about what is possible and what I should be achieving in my rental, you might go in and be able to access some of that data, run a comps report, and we'd be able to run the analytics on our side and give you some of that information saying, Alan, based on the characteristics that you're describing in your property, based on your census block where you are, this is really what you should be able to achieve in those rentals. So that's really kind of, our future ambition where we're looking to go from here.
Well, that would just be invaluable. Well, that Chandan.com is where you're going to find that, and Chandan is spelled with Chandan. And you can, of course, find that in our notes as well. Well, Jonathan, tell us just a little bit here. We're running out of time, but just real quickly, tell us about the debt market and the fact that interest rates are increasing, and certainly the Fed has told us they're going to continue to increase. What impact is that going to have on mom and pop?
So the mom and pop would actually probably be the most sensitive, especially if it's the case that you have, floating rate debt. Looking on our side, the amount of, debt that's in the entirety of multifamily market in the United States has increased by about 150% since the Great Recession. The amount of units that has increased has been about 19%. So you just have a lot more debt capital chasing, a disproportionate amount of assets, so a disproportionately lower amount of assets. So if we're running into a case where interest rates are rising and I'm unable to boost the cash flows within my property quickly enough, because say I only own 4 units, my debt costs have risen by 50, 60 bips within a couple months, you could potentially run into some issues there. So as far as potential for distress, I would view it that that's where we'd be most likely to see it. Granted, we're of a view that a lot of the signaling that is going on by the Fed right now has already fed into market interest rates. I think that for the first time last week, the 30-year fixed Fannie interest rate rose to 4.4% for the first time since 2019. If you're looking through the rest of the year, the Fed is signaling that they're going to raise interest rates at each one of their next meetings, likely raising 7 or 8, about 200 basis points higher from where we currently are right now. However, if you look at things like the Wall Street Journal Economic Forecasting Survey, they're saying that the 10-year is going to end the year around 2.2%. That's as of January, so it's a little bit dated. But even if you look at things like Goldman Sachs last week said, hey, we're going to be a little bit more hawkish. We think that it's going to be raising to 2.7%. It's higher than that 2.2, but that's right around in line of where the federal funds rate is going to be ending. So what that really speaks to is that, at least in our minds, a lot of the impact on those long-term interest rates that are in the market have already started to feed through, because the Fed is unable to directly impact that side, and market pricing there is dictated by expectations. And
so you think the 30 rates may be stabilizing around the 4.5%? Is that what you're speculating?
Potentially. I think that more so that we're going to see the movements based on the Fed signaling future interest rates rather than the interest rate moves themselves. So the fact that they have signaled that they are going to raise by as much as 200 basis points this year, 7 times, once the market knows that, you're going to see that feed through to market pricing almost immediately.
Well, Jonathan, very informative time today. And viewers and listeners, thank you so much for being with us. And thank you, Jonathan, for sharing your knowledge and wisdom with us today.
Thank you, Alan. It's been a pleasure.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.